This is your 12th program in the series on accounting. In accrual accounting systems, sales stock and other assets which are used, sold, or expended in one period, but paid for in another period, are properly charged by increasing or decreasing asset, liability, and expense accounts independently from cash. Salaries, interest, and taxes payable are examples of expenses which are typically accrued before they are paid for. On the other hand, goods held in inventory for sale and certain prepaid expenses such as rent and insurance are often paid for before their sale or use. They are still considered short-term assets providing relatively early benefits. How would they be listed? A merchant, manufacturer, or even a service business which also sells parts must account for its saleable inventory of goods at the end of each fiscal year. The obvious way to do this is to count the kind and number of items on the shelves or in cartons. What would you think this process is called? Yes. In this way, the quantity of goods on hand at a certain time is positively determined. You can easily imagine how important this is, since many companies have experienced severe problems because of financial records which did not reflect the actual amount and value of the physical inventory. Since taking a physical inventory is time-consuming, it is usually performed only once or twice a year. It is most conveniently done, of course, when it is smallest, and this usually is the case in certain times of the year due to seasonal factors. Since this is not always on December 31st, some firms prefer to establish their business or fiscal year periods to end on some other date. Taking inventory must be well organized and efficiently performed, or it will be an endless, expensive task and may contain serious errors. Traditionally, it is done in several steps. First, a caller looks at goods on the shelf and calls out the item names and quantities to another person who enters the information on a list. What is the name for the yearly business period selected by a firm for its convenience, especially for inventory? Right. Nowadays, the inventory may be called out by an employee who uses a tape recorder rather than to another person standing by. In either case, it is more efficient than the caller making the entries himself as he looks through the goods. After entry, goods are costed and extended. An inventory sheet will show the word inventory, a date, page number, department, location, caller's name, and the names of those who enter the information, add the prices, and multiply to obtain the value of the items. How would the typical steps be described? A physical inventory is expensive and often disruptive to the work of others, so it is important to perform it quickly. Another reason for quickness is that errors in counting or failing to count goods in the process of reception or shipment in transit should be avoided. When in doubt, all items physically present should be described, counted, and listed with time, location, and situation and labeling included, with comments as to possible effective ownership. The firm owns all goods from suppliers which are present and have been billed, and goods to customers which are present and have not yet been charged to them. Why should inventory be performed promptly? After inventory has been called and entered, a price must be assigned. This is costing. If some items of the same kind were purchased at one price, some at another, and new purchases would have to be at still another price, a question arises as to how to assign the cost. If all items of a kind are alike, It is impractical to cost some of them at one amount and others at different amounts. If 1-horsepower motors, which ordinarily sell for $100, have been purchased, some for $64 and some $68, they may all be priced at $64, $68, or at a weighted average, say $66. Or if they are now available at $60 or $70 from suppliers, competitive or sales considerations might call for the use of one of these figures. Which price would be absolutely correct? Yes. During a period of a year, 5,000 units may have been purchased with 1,000 left on hand in inventory. If at the beginning of the year the items were purchased at $64 and near the end at $68, it might seem reasonable to assign the latter value to inventory. This process is called first in, first out, or FIFO costing. FIFO costing, because of its apparently reasonable nature, is widely used. The older goods are usually sold first for obvious reasons. Further, the latest price usually best represents the price of additional purchases when necessary. Also, this is the traditional way, and the basic values of accounting are based on tradition and consistency with previous practices. What does FIFO stand for? Yes. But let's say you owned a small oil company, and you paid $2 per barrel for oil until December, during which you bought a little oil at $12 per barrel, a bargain when others were paying $14. But to refine, process, store, and ship it, you must keep a 180-day supply. Should you use the FIFO method and cost your inventory at $12, showing an unrealized profit and paying income taxes on it, when prices might soon drop to $6 in the coming year, say due to price controls? In such a situation, you might prefer to say that your cost of at least some of the goods sold recently was at the last higher purchase price. This would lower your declared profit and lower your income tax liability. If the tax regulations allow it, as they usually do, you might choose this method. Which do you think it is called? Yes. FIFO, or first in, first out, usually represents the actual facts and is traditional. In periods of inflation, LIFO, or last in, first out, is more conservative and saves taxes. If 1,000 motors at $62 were beginning inventory, 1,000 were purchased at $64, 1,000 at $66, and 1,000 at $68, and at the final inventory there were only 2,000 in stock, FIFO would assign them an average value of $67. What value would be assigned using the LIFO system? Yes. You might say that there were during the year altogether 400 motors available for sale with an average cost of $65, and that a reasonable value for the ending inventory would thus be $65. This is called a weighted cost averaging. This method, despite its reasonableness, doesn't satisfy the proponents of either FIFO or LIFO. For a refinery, steel mill, or coal plant, with a process which requires a constant inventory of several months' supply, this minimum inventory is a little like an original capital investment which is never sold and should never be marked up in price. What kind of costing is indicated in such a case? Right. The same model of calculator you bought at $20 to sell at $30 may be purchased now at $5 to sell at $10. If you're now selling the calculators you originally purchased at $20 at a loss for $9.95, what would be a prudent value for your remaining inventory? Accountants are rather conservative. The conservative rule, sometimes called the principle of conservatism, is a common choice. This rule provides for all reasonable losses which can be anticipated, but does not anticipate gains. In applying the conservative rule to inventory costing, we could use the lower of original or replacement cost. This would mean $2 oil or $5 calculators in inventory, with the cost assigned to the goods which were sold being higher and the indicated profits lower than otherwise. If a refinery has a stock inventory originally priced at $1 million and other assets worth another $1 million, the entire facility may be worth $2 million as a going business. But if it were closed down, the oil inventory in process may actually be worth $5 million at current prices. What do we call the policy which calls for pricing at the lower of market or original cost? Right. Interim estimates of the cost of goods sold and in inventory are made without taking inventory, for interim reports such as monthly or quarterly. One way to make these estimates is by determining the average percent of total sales which has historically been made up of cost of goods sold and what percent was gross margin. For example, if cost of goods sold has been 60%, ranging say between 58% and 62% of sales in the past, with a gross margin of about 40%, you could estimate the cost of goods sold on sales of $10,000 as $6,000, with a margin of $4,000 before expenses and taxes. Why is it necessary to make such estimates of the cost of goods and remaining inventory? Yes. The method of estimated percentage allocation to cost of goods sold and gross margin can be useful in showing what the actual inventory should be at any time. Any material differences between the book inventory and the actual inventory should be cause for concern and investigation. Another method of allocating goods sold and inventory cost uses the ratio of current and historical wholesale to retail costs. A third method employs perpetual inventory records, which indicates the inventory which should be on hand by recording additions and reductions as a result of purchases and sales. This kind of book inventory system is only economical, however, for inventory which consists of rather valuable units such as television sets or automobiles. As the cost of handling data is reduced by means of electronic data processing, it will be feasible to keep account of less expensive items. What are some ways of making interim estimates of cost of goods sold and merchandise inventory? The formula for cost of goods sold, if you will recall, is the purchases plus inventory decrease, if any. The complete formula is CGS equals purchases plus beginning inventory minus ending inventory. After finding the gross margin, expenses must be subtracted to obtain profit. Some expenses are relatively constant, salaries, utilities, and the like. But other expenses occur or must be paid all at once, although they apply to operations which extend for a longer period. What do you think are examples of these one-time expenses? Right. Separate accounts may be set up for a number of assets like office supplies, postage stamps or meter tapes, store supplies like bags and wrapping paper, catalogs and other advertising supplies, insurance premiums, prepaid interest, and the like. But several of the smaller assets of this non-merchandise type are often combined in a single prepaid expenses account. There are two ways of considering expenses which are in part prepaid. First, if much of the cost may be represented by unused assets at the end of a period, they may all be set up as the asset prepaid expenses when paid or charged for. Then at the end of the period, their remaining value is retained, and the balance, the used-up part, is charged to the proper expense account. This is the asset method for accounting for prepayments. The second way charges all costs to expenses as incurred, then like the first method, the remaining value is determined and temporarily transferred to a prepaid expenses asset account. The process is different, but at year end, are the results the same? In the asset method of prepayment accounting, if one day the firm bought $500 worth of paper, envelopes, ballpoint pens, and other office supplies, $600 of shipping bags, boxes and oils, cleaners and other store supplies, $800 of special catalogs and circulars, $300 of stamps and postage meter deposits, and paid $400 for a new insurance policy, how much would be entered as assets and how much as expenses on that first day? Yes. But if the expenses method of prepayment accounting were used, all $2,600 of payments would be expenses. Then, as with the asset method, at the end of the accounting period, the remaining value of each item paid for would be calculated or inventoried, and expenses would be reduced by this amount. In order to make the expense method correct from period to period, the prepaid expenses asset account must be again expensed on the first day of the new period, and included along with the amount of expense payments in the new period. Postage stamps, catalogs, and envelopes can be counted and valued, but the value of unexpired prepaid insurance must be calculated by subtracting that portion of the entire prepaid period of the insurance policy, which might be 12 months, which has expired at the end of the accounting period, which might be 3 months. If $400 were prepaid on October 1 for a year's insurance, what would be shown on December 31st as the expenses and remaining asset? Most firms have several insurance policies for fire, casualty, compensation, and the like. They are important documents and their details should be quickly available. Important data on the insurance company, date and number of policy, expiration date, total premium, and monthly cost can be entered on appropriate lines in an insurance policy register. The cost of taking physical inventory of office supplies, accounting for inventory, and accounting for prepaid expenses should be balanced against the benefits of having such information. In some cases, the benefits may be trivial, since the costs are evenly distributed among accounting periods, or are not large compared with other costs. In this case, what could be done? Yes. Goods for sale, supplies, and other prepaid expenses are often purchased or paid for in an accounting period before the one they benefit. But they are not held as an asset for long, like equipment or other fixed or long-lived assets, so they are considered current assets. In the next program, you will learn about accounting for fixed assets.